fundamental research, which we're now starting to unpack, suggests we have a middling probability of remaining in a risk-on condition. I'll say this right now, there's a lot of conflicting data right now from the perspective of the economy. When you think about growth, inflation, and policy, there's a lot of conflicting data from the perspective of our quantitative risk management systems. They were, when we go back to, early, the last time we had a pivot was, late October, early November, everything was pointing up and to the right from the perspective of our quantitative risk management signals, from the perspective of our fundamental research process. And it got increasingly pointed up and to the right by the time we got to the mid to late November. And so, we don't want to have the same level of conviction in the direction in our assessment of the likely direction of asset markets at every juncture. That's a parlor game. That's preposterous. There are times where you should be extremely convicted in a high probability scenario, like going back to December of 2021, we were extremely highly convicted in the bear case, in the left tail risk associated with asset markets and the economy. Going back to January of 2023, we were not highly, but probably reasonably highly convicted in the upside risk in both the economy and asset markets, and that was right. And so, again, there's not at every moment are you going to have a lot of conviction based on where you are in the growth cycle, based on where you are in the inflation cycle, based on where you are in the policy cycle, and also where you are in the positioning cycle. There are times where you can have a significant amount of conviction because where you are in those cycles are generally pointing in one direction or another, but right now they're not. And so we're not going to come on here in this program, mid-May and just say, hey, well, you guys are paying me to have a extreme amount of conviction, irrespective of what the models and risk management systems are saying. That's not what you're paying us for. You're paying us to deliver superior outcomes from the perspective of your portfolio, and that's what we're going to do. And the best way we know how to do that is to be honest with our assessments of what's happening in the economy and in the financial markets. And right now, the key takeaway from this rant is I don't know. I can make a really credible, a real credible bull case, in so much as I can paint a real credible bear case, because again, the signals from a growth, inflation, policy, and positioning perspective are now starting to say some very different things. And so, when those signals are no longer ubiquitously confirming one direction or another, in my opinion, it's very important to just rely on your core risk management signals. And from the perspective of our core risk management signals, if you're a retail investor, that's KISS. If you're a sophisticated retail investor or investment advisor, that's KISS and or a customized version of KISS. And if you're an institutional investor, it's aligning your playbook and your positions and your portfolios with the current market regime. And maybe if you have a view that, maybe perhaps we are going to transition out of the current market regime, in a reasonable enough time horizon to start doing something about that in your portfolio, then that's why we're having these conversations about what the next market regime might be, so we can help you practically prepare to do some of those things if you're managing billions of dollars and can't turn on a dime like some of our retail and investment advisor clients can do. So that's the best we can do. Sometimes, again, we have very high conviction. Sometimes we don't have high conviction. This is not one of those times where we have high conviction in the near-term direction of asset markets. And quite frankly, I think we should be celebrated for that honesty, as opposed to derided for that honesty, because I know you can go get a ton of conviction from Twitter, but I'm not sure you can get a ton of positive outcomes in your portfolio from that.